Well, good afternoon, everyone. Thank you for joining us. My name's Nate Angelo, I'm the Chief Executive Officer here at Composition Wealth, and joined by Matt Dimitrison, our CIO here at Composition Wealth. For those of you that joined our last conversation, you heard us introduce this idea of ITAP. It's an acronym that we're using to really encapsulate what we have seen as key market drivers in 2026. And so ITAP stands for Iran, tariffs, artificial intelligence, and private credit. And this continued dialogue that we are having this afternoon is really going to be a 20-minute conversation talking about what's going on in each of these four areas as we continue to see market volatility and clearly things continue to unfold in Iran is probably most front and center as we speak. But nonetheless, private credit just doesn't seem to want to go away. AI is clearly here to stay. And tariffs, it was only a month ago that we were talking about tariffs. February feels like so long ago. So we want to make sure we touch on all four of these things as our clients are continuing to reach out to us. I got an email from a client just the other day asking, hey, should this be a strategic shift in the portfolio entirely? Is this a buying opportunity? Should we be going to cash? So again, we're flooded with these emotions as it pertains to some of these key drivers. And so I think we want to spend some time unpacking the truth and the details, the facts that are within these key drivers so that we can continue to make very rational decisions about our portfolios, what we hold, and then also just remain grounded in sort of this longer term view around where are we headed tied to our ultimate, our own personal goals and ambitions and the outcomes that we're looking for. So let's dive into ITAP and let's start with the I, which is Iran, as I mentioned a moment ago. You know, a lot of significant outcomes, specifically economic outcomes, can come from oil. They have the oil price itself has a tremendous impact on the broader global economy. And while I think sometimes it gets forgotten that Iran is producing, less than 5%, I think the number is of global oil demand. It's roughly the 20% of global oil supply, though, that passes through the Strait of Hormuz, which, or Iran has off and on again attempted to close, and that creates a lot of consternation, specifically in the Gulf, but then has downstream impacts, across the globe. There's also concerns about supply disruptions, that have led crude, to price, from a price spike perspective, up, I think, over 50% since the conflict began. And this is disconcerting for people. And so as we enter this fourth week of the conflict, the risk of economic pressures continues to mount. And so I think, Matt, it'd be great if you could unpack and maybe, if I could use the words, just level set for us, what we see as an impact around the economics tied to oil, for the broader globe.
Yeah, sure, Nate. And you kind of hit it right in that 20% of the global oil supply goes through the Strait of Hormuz. So that's impactful. If we look at kind of that 20%, and so if you round numbers, the globe consumes about 100 million barrels a day of oil. And so that 20% equates to about 20 million barrels a day of oil. If we look at that 20 million barrels now, about 6 or 7 million barrels have actually been moved outside of the strait, so they can actually go via pipeline to other parts and get out on cargo ships outside of the Strait of Hormuz. So we're really looking at about two-thirds of that 20% that's still kind of landlocked where we have supply constraints. Where is that supply going? Well, of that, call it 20 million barrels that go through the Strait of Hormuz, about 13 or 14 go to Asia. China's the biggest consumer, India's a consumer, Japan's a consumer. And so, Asia is going to be most impacted from that supply disruption. And I think some of the concerns that we have now that we're in the fourth week is if this continues, could we get to a point where there actually has to be rationing of supply? Europe, while they consume Middle Eastern oil and oil that comes from the Strait, is not as big of a consumer, so we're a little bit less isolated there. So that's crude. If we move on to gas, natural gas, one of the big outcomes of Russia's invasion of Ukraine is Europe kind of shut off taking Russian gas. So what they started doing was taking more liquefied natural gas, or LNG. Qatar has a massive oil gas field, and they're becoming a larger and larger producer of LNG. A good chunk of that goes to Europe, Asia as well, but a good chunk of that goes to Europe. So when you actually look at natural gas prices, they're up 90% in Europe. You compare that to the US, natural gas prices are about flat since March. And the difference is oil's more of a global commodity. Natural gas is more of a local commodity. It's hard to transport it. It costs a lot to liquefy it to turn it into LNG. So it tends to be more of a local commodity. So Europe's going to face a little bit more inflationary pressures and impact. Europe's also more of an industrial economy, and so they need more LNG or natural gas to power their factories and the like. And so I would say Europe and Asia are going to be disproportionately impacted by this. The third element is petrochemicals. So plastics, fertilizers, even some pharmaceutical products have petrochemicals in that. Also, somewhat of an impact depending on the location, but in general, those products are going to see price hikes of 30 to 60% is kind of what we're seeing. So as you said, Nate, the economic impacts really stem from oil and oil byproducts, and that's kind of what we're seeing play out to varying degrees by geography.
Yeah, and I think when we think about risks or downstream impact, one of the things we always have to think about is time. And so I think we're all looking for some resolution, sooner than later as it pertains specifically to the hostilities. And then, ideally we'd get some sort of longer term agreement in place, how we get there and when we get there, we'll see. But if we were able to do that in relatively short order, what's the time on the backside that we're looking at for getting, oil production back to whatever normal, the new normal would become?
Yeah, you're spot on, Nate. It's going to take some time. The strait, first of all, we don't really know how safe the strait is to travel through. That's going to have to be figured out for one. The second piece is just the logistics of it. There's not necessarily ships in the right lanes at the moment. They're docked in areas where they still need to be unloaded before they can actually take new cargo on. And so getting those ships in the right lanes is going to take some time. There's going to be some wells that were capped and aren't still producing oil because there's no place to put it at the moment. So this isn't going to be something that's going to turn on overnight and be fixed in 2 weeks or 3 weeks or even maybe a matter of a couple of months. One of the indicators we actually look at is oil futures. So if I wanted to sell oil, I could buy a futures contract and sell that oil at a predefined price in July or December. And so these future contracts are monthly and they go out several years. And so when we look at what's priced into those futures contracts, it's an idea of kind of how the market is expecting this to kind of level out, to your point, Nate, once maybe hopefully hostilities start to end. And as I was looking at those future contracts earlier today, if you look at oil, so West Texas crude oil, so that's what's produced in the US, that's sitting at about $91 a barrel today. It's not expected to go below $80 a barrel until September and not expected to go below $75 a barrel until February. So if we think of where we were at even before March, which was sub $70, the market's kind of saying it could take, well over a year before that starts to happen. I would say the futures market tends to be kind of directionally correct, not always spot on accurate, but I think it's a good guideline that it's just to go back to where we were a mere month ago, is likely to take a year or longer, depending on how easy it is to get everything back in shape. So I think some of the economic damage is starting to already happen. I think the longer this conflict goes on, then we start to worry that it's going to be more significant. At this point, it's probably impairing the rate of economic growth across the globe. Again, Asia may feel it a little bit more than the US is going to feel it, but it's not exactly at the point level where we're getting overly concerned. But as time goes on, I think our views could change if we don't see a resolution here in the near term.
Yeah, well said. Yeah, I think it's probably best to summarize, modest impacts are starting to happen and we'll see where this goes. And I failed to say this up front, but there is a chat feature. So if you do a Q&A feature in the Zoom link, so if you are on and you do have a question you want to type into the chat, we'll do our best to weave those into our conversation. So that's a great summary on Iran. Let's shift gears now to tariffs. I know it's been a little bit more quiet on the tariff front. I think we'd be remiss, though, not to address this as we think about the 2026, market drivers tied to volatility and market movement. It was in February where the Supreme Court came out. They overturned the IEEPA method for imposing tariffs. And so, I think the question we have here is twofold. One is, does this mean that, tariffs and or the concern for tariffs is gone? We also know that, the president found another path forward to implement shorter term tariffs, or at least for a stated period of time. How do we see the tariff sort of trade unfolding on a go forward?
Yeah, so those Section 122 tariffs that you mentioned, Nate, give the administration 150 days to impose a tariff. They've set it at 10%. They've indicated they could go to 15, but 10% is where they're at the moment. And so that really gets them into July. There's other sections of the Trade Act that they can impose tariffs on. They all have differing requirements of what needs to be proved. They all have differing levels of the amount of tariff that can be applied. So the administration's kind of back with the puzzles back on the taken apart, having to put the puzzle back together on tariffs. And they kind of have between now and July to start to put that in motion. Look, it's possible they may not get everything figured out between now and July and all the court rulings to be in place. And so we may see some tariffs come back off before they get put back on. So I think there'll be some movement going on. But to your point, Nate, I think it's kind of in the background until June, maybe even early July, and then it'll probably start to become a more significant impact on concerns on the economy, concerns on the market. But I think one positive is I think we've all kind of embedded some expectation of tariffs. So it's really just a function of how the new tariff pieces get put together and whether we have slightly higher or slightly lower tariffs than we did prior to the Supreme Court ruling.
Yeah, and I think let's pair Iran and tariffs together for a moment, and talk a little bit just about inflation. And do we see both of these items as continuing to be inflationary on a go forward looking basis? How do we think about the test of time with inflation as well? I think time is always really important around inflation. What are your thoughts around that?
Yeah, I think the answer is it'll be inflationary, but not extreme inflation in and of themselves. So at the moment, where the 50% move in oil prices probably adds a little over 1% to inflation if it were to kind of remain around this level for a good chunk of the year. The tariff side of things, we'd actually seen limited impact, especially in the back half of last year on tariffs. We're starting to see one indicator we look at is the producer price index, which is input prices into manufacturers and industrial companies. That started to rise the last couple of months. So that is indicative that maybe there's still some tariffs being passed on. Companies were waiting until the new year to start to increase prices. That's maybe starting to come through. So maybe we're seeing a little bit of an impact from tariff price increases, but a good chunk of that has been passed through. So when we look back to 2022 and when we were seeing 9% inflation, we don't think that's in the table, but could we go from 2.5% inflation to 3.5 to maybe pushing 4? That's a possibility. I think our base case is still we're probably going to be around 3%, but that assumes that we have a resolution to the conflict in Iran fairly soon.
Yeah. Great. Now let's shift gears into the A, artificial intelligence, otherwise known as AI. For many of us, we've certainly heard the names or have been, looking into OpenAI, Anthropic. Some of us are starting to use Claude in terms of an ability, an entirely new way to code and to be able to move at speeds much quicker than you used to when you had to use different coding mechanisms to build new algorithms that can create new content, that can create documents, that can create presentations, that can totally transform how you run a process. Some of us are more familiar maybe with Gemini, or you've used what might be a more introductory level AI tool in Copilot, just built into your everyday Microsoft functions for which we all live in. How, as AI comes to the forefront, we as a company, Composition Wealth, are leveraging AI to expedite processes, to create more efficiencies for advisors and client service team members. We're also recognizing that there's concerns and security issues around AI, and so we're factoring all of these in, like many other companies and in many other industries. Question for you, Matt, is, as we think, as you and the investment team holistically, as you're thinking about the disruptive nature of AI and specifically tied to software companies, like what well, look, like some of these software companies have been darlings of the market for quite some time. They've taken big hits. How do we see that on a go forward basis based on where we're at today and where we think things may settle into the future?
Yeah, there's no question there's going to be some disruption coming. When we look at kind of what's happened with stock prices on a lot of software companies, they're down 20-25% on the year. And I think one of the things the market's implying is a lot of these companies are going to be left for dead or a lot less impactful than they were. And I think as we talk to companies both in the public and the private realm, what's very apparent is every software company has an AI agenda and an AI plan that they're working on. And so it's not just, hey, this is a legacy software application and it's going to get disrupted by a native AI player. They're actually starting to build their own AI capabilities that are going to compete against what a native AI player can be, and they may not be disrupted. We've long kind of had this view that, if you're kind of a system of record, if you're an integral part of the day-to-day operations of the business, if you're building and creating your own data in the software, those are going to be harder to rip out and replace, and we still believe that. So there's going to be some software companies that we think are going to be better positioned than others. But at the same time, we have to be humble enough to recognize that this is a quickly evolving landscape. And just because Claude's a great tool today doesn't mean a more legacy software application doesn't have some new capabilities that they're working on, behind the scenes that might not be apparent for 6 or 12 months from now. I think the other thing that we're starting to look at is the economics around software are going to change. If you look back 10 years ago, it was more of a license model. You would every 2 or 3 years you'd upgrade from version 2.0 to 3.0. And then that switched to, this SaaS moniker, software as a service, or I paid per seat. And that worked really well for software companies because it actually made their businesses more recurring revenue, higher margins. People were willing to pay higher prices, which is why we had kind of higher valuations and those stocks were so good in the market. One of the things I'm starting to hear more and more companies talk about is when we move to an AI world, maybe that software model and business model changes a little bit. If I'm going to offload some of my tasks to AI to do instead of paying an employee to do it, they might actually, that software company, AI software company, may want to be paid per activity or per task. And so now their business model is going to start to change. The more and more I use it, the more money they're going to start to make. And so I think that transition is going to take some time. I wouldn't be surprised if there was some hiccups along the way. There was when the software world went from licensed to SaaS or subscription based. So I think things are changing as well as the margins of those business could change. If they have less coders because AI can help with the code, that can also be pretty good for their margins as well. So a lot of moving pieces there. We're starting to look and see some opportunities where there could be some attractive valuations in public software companies, but we're also humble enough to realize this pieces we don't know. And so we want to go where we have conviction and certainty and where the risk reward is more attractive.
Yeah, and I think getting to our final category here, the P, which stands for private credit, there's a direct correlation between AI and private credit as it stands today in terms of what's been happening in the market. And largely that's due to, from a private credit perspective, one of their biggest places to deploy capital has been software. And I think it's software companies are representing, 20% of this universe. And so as this occurs, demand from the sector and the sticky nature of the recurring seat licenses of software companies has made this sector attractive over time for private credit. It's said another way, it's a great place to invest. As you talked about this licensing model that moved to SaaS, they had pricing power. So it was
Mhm.
very easy to go back to those clients and simply raise the price, and you had a captive audience that was almost forced to pay because it was embedded in their systems. And so can you talk a little bit now in terms of like how are you thinking about the AI risks that private credit managers may face in their software exposure specifically?
Yeah, so going back to my prior comment, there's going to be some disruption. There'll probably be a couple of, there will be software companies that go out of business, which in the private credit world means there might be some defaults, but not every company is going to go out of business. And there's going to be a lot of opportunities there, especially those that have strong business models where they are system of record and integral to the management of the business. And so, as you mentioned, about 20% of the private credit universe is software companies. If we sit there and just do some quick back of the envelope math, and let's just say half of them default, which is an extreme outcome. If you go back to the great financial crisis, 10% of private credit companies defaulted. So this is a more extreme level, but just say that happens. When a company defaults, the private credit firm takes over the business and they try to sell the business. They, take out any value of underlying assets. And that's kind of called the recovery value. So whatever they can kind of get out of the value of the business when they take it over. So historically, private credit, and if you look at the last 10 years, has recovered about 55 to 60% of the value of a software business when there's been a default. Let's say that goes down to 20%. So now I've taken 20% of the universe of software, half default, so I've lost 10%. I can only recover, 20% of that, so I've lost 8%. So that's, I would argue, a pretty rough scenario. That's also going to be spread over time. We know not every business is going to fail tomorrow or fail on, July 1st of 2027. And so that could be spread over a number of years. So if you spread 8% defaults over 3 years, that's about 2.7% per year. Private credit funds on average are paying 9%. So if I take out 2.7%, I'm still making a little north of 6%. Not as great as 9. I'd rather have 9, but that's not a horrific outcome, at least from our view. On top of that, this is an environment, and it really applies to picking software stocks as well as in private credit lending, where we think it's a asset selection market of picking the right assets and avoiding the wrong assets. And we think investing with investors that have been diligent underwriters, look at these risks, really understand the business and the recurring nature and the ability to weather an AI storm, we think are going to perform a lot better than average. And we're spending a lot of time making sure our clients are invested in those managers that are going to do better than average as we work through this period.
So to put a finer, point or an exclamation point on that, if I hear you correctly, you're not seeing today deteriorating financial performance and defaults like emerging or accelerating, not right now. Is that accurate?
Yeah, we're not seeing the defaults. The strategies we invest with have not even a single loan that's late on its payment. They're growing their cash earnings by, double digits, almost mid-teens. Credit conditions are actually good today. We've got to recognize that conditions may change over time, but we're not seeing any of that pressure today.
Great. So we've talked through ITAP. Just a couple follow-up questions just before we wrap up here in the next few minutes. As we sat, I think as we went into today, the markets have been down roughly, the S&P, like I think 5% year to date.
Mhm.
Massive headlines between January 1st and today. Help put into perspective, Matt, what a typical drawdown might be at any given point in a year, just to help people understand and remind ourselves that while these headlines draw out the emotion, we can't lose the rational thinking and perspective in terms of how markets move in any given period of time.
In an average year, the S&P 500 draws down or has experienced a period of a 14% decline. So when you look at that, we're down 5% on the year. Now we were up 3, 4, 5% earlier in the year, so we've maybe experienced close to a 10% decline at this point. This is still within a very normal year that we're experiencing.
Yeah. And the last question, I use this word a couple times in the word time. And I think a lot of what we just talked about in the headlines that we're seeing today are going to, their impact will be significantly greater if these things continue, i.e., Iran goes on for 6 months. Maybe it's really hard to run scenarios at 30-day increments. But if I could maybe challenge you, Matt, here just to take this question that is, we think if this comes to a conclusion in the short run, we'll be like things will slowly normalize, we can recover from it. Let's just take this out of ways. Like if this goes on for 6 months, how do we think about inflation? How do we think about, challenges with the oil markets broadly? What, early just stage comments might you share in terms of where this could go?
Yeah, I think obviously the longer it drags on, I think you're going to see, higher oil prices is going to be significant oil shortages, as that happens. So that's going to drive inflation higher. The balancing piece of that is it's probably also going to slow economic growth. And so that's the tricky part with the inflation is, yes, oil prices are higher, but if people are less comfortable in buying airline tickets and going to Disney World and eating out at restaurants, that might actually create, disinflation or even deflation in other segments of the economy. So in such an environment, we'd probably be focused more on quality. So we'd be going up in quality in equities. We'd be looking for, up in quality in our bond portfolios. We'd probably be a little bit more US centric than we are today. So in that scenario, that's probably what we would be looking for as that happens.
Yeah, that's great. And one final question as and we'll wrap. Going back to private credit, we have private credit in some of our portfolios. Not all private credit is created equal. Um,
Yep.
Negative sentimentism is a powerful thing. When you see very negative headlines, it's very easy for people to then want to fast follow. So one of the questions that an audience member posted was, "Hey, if this is still a decent investment, why is there so much negative coverage about the private credit space?" And so maybe you could just provide some perspective on your thoughts there.
Yeah, it's a good question and a fair one. I had one firm mention to me that a large media outlet has 12 reporters covering private credit. So they're just picking up any story that comes out there. I initially dismissed it, but as I continue to see any little headline that is out there getting picked up, I'm starting to believe that's the case. I think the other piece is I don't think the media reports necessarily understand some of the structures. So, some of the latest headlines are this fund or that fund, had redemptions over their 5% quarterly limit because those funds offer 5% of the portfolio's assets as liquidity every quarter. That's always how those structures were designed. We, expect over a market cycle is going to be periods where there's going to be more redemptions than 5%. That structure is in place to benefit those that want liquidity, but also those that want to remain in the fund. You're not being forced to sell assets at distressed prices. And so it's I think, a prudent mechanism to kind of serve both interests. And the media reports aren't really focused on that. It's just there's this level of redemptions that are going on. So I can't exactly answer the question exactly why every media outlet is picking that up, but I think part of it is just increased reporters dedicated to that function.
Yeah, it's getting readership right now, so
It is.
why would you not? Well, Matt, thanks a ton for your time. Always appreciate your insights and the broader team's insights for that matter. Thank you for joining us. We will be back again soon to continue our updates on ITAP and how these four key market drivers are impacting markets, the economy, and ultimately portfolios. Thank you for your trust and the opportunity to serve you. If you have questions that we were not able to get to today, please feel free to reach out to your financial advisor or find us at composition.com. Thank you so much.